What's up, boss? It's your boy Lou of Wall Street. What's going on? Again, my channel is about serious investing. I'm here to give you ideas, frameworks, and most importantly, perspectives in a professional, clear, and concise fashion. And I hope you bought some metal futures, SLV, CPR after watching my last video. Today, we're going to put historical performance of US stock market into perspectives and answer the question whether and how overheated is the US stock market after the bull run in 2020, using a simple mathematical approach which most hedge fund professionals tend to ignore. For example, eyeballing this historical chart for S&P 500, intuitively you would think the US equity market has probably run its course after 2020 and the correction could be imminent. You may not be wrong, but before doing anything, I want to make sure that you understand this one important concept hidden on this chart. That is the power of compounding. More specifically, on the normal scale chart, it reflects your actual price return compounded through time. The compounding effect will automatically make the price chart look exponential, thus visually amplifying price changes in more recent time period versus before, making the price movement in recent period exaggerated to your eyes. Just to prove my point, here is the very same chart for S&P 500, but only up to February 2020, just before the impact of pandemic hit. Can you really tell this chart is any different from the previous one? In order to put things into better perspectives, we can plot the very same price chart in log scale, which adjusts out the compounding effect through time. Here it is. In another word, this chart shows the uncompounded return over time. As expected, it has followed a straight line over time. The slope of the trend line actually tells us the average uncompounded annual return for S&P 500, which is about 6% since 1930. More importantly, it looks like the price movement post March 2020 hasn't been that crazy from this chart when put into the perspectives of history, especially with the flooding liquidity pumped by our best friend, Uncle Powell, which seems to be here to stay for now. The takeaway here is that as investors, you should look at any chart with the right context. In this particular case, knowing the power of compounding. The truth is, if you invested $5,000 into S&P 500 60 years ago, you would be a multi-millionaire by now. Again, my friend, if you are loading S&P or QQQ pools to YOLO or to event hedge your portfolio, be my guest. I've also plotted the log scale chart for Tesla prices for you to see. That's it for today. Hope you had fun watching this video and hope the simple, high-level perspectives shared by me are helpful to you. In the next video, I will be sharing my current views on the US equity market in a systematic way. If you like what you hear, please click the subscribe button. Have a nice day, folks.